Down to number 61 on page 5-45. And again, in most of these cases, I have changed some. Actually, in some of these cases, I've changed some of the data. In other cases, I have not. In this case, it looks like, and in fact, several of these, I have left the data as it is because they're not listed in Connect this week. So less of the data is adjusted in this Excel spreadsheet. All right, so number 61, Adrian contributed an antique vase she had owned for 25 years to a museum. At the time of the donation, though, the vase had a market value of $35,000. The museum displayed this vase in the art gallery. Assume that Adrian's AGI in case number A, that her AGI is $80,000 and her basis in the vase is $15,000. How much can Adrian deduct? All right, so in this case, we have to look at the fair market value. We have to list the AGI, the basis in the vase if that's necessary. Now you'll notice it's not 50%, but it's only 30% because this is capital gain property. That is to say, this capital investment increased from $15,000 to $35,000. Therefore, if the deduction she's going to take a deduction for $35,000 or list at fair market value, then she's limited to 30% of AGI. So in this case, even though the deduction was at $35,000, she's limited to 30% of her AGI, and 30% of $80,000 is $24,000. So this $24,000 then is the amount she can deduct this year for that $35,000 deduction. The other $11,000 can be carried forward for up to 5 years. So a complication is added in Part B. It says, how would you answer Part A, and how would this answer change if instead of displaying the vase, the museum sold the vase to an antique dealer? So this is a case where the donee is not really using the donation for its intended use, right? It was designed to be displayed in the museum, and now it's not being displayed. So in this case, it's capital gain property, but the donor is really limited to, in the first year, to 50% of AGI of $40,000, but the allowable contribution, because the use of this vase was not, the donee did not use this vase for its intended purpose, it liquidated it, sold it right away, then only $15,000 is permitted as a deduction, which is the basis. So in this case, it'll be the lower of 50% of the AGI or the basis of the deduction, in which case is $15,000. So that's a little bit interesting. The percent goes up, but unfortunately, the donor has to use $15,000 as the basis for the first year. And then in subsequent years, up to 5 years, using the same rules, like next year, this $20,000 can be taken later on. Likely $15,000 next year, and then $5,000 the following year. And for number 63, I just wanted to mention this one, and number 63 is found on page 546. Here's a case where we have Ronaldo and Sonia, a married couple. They had flood damage in their home due to a faulty water heater during 2017, which ruined the furniture that was stored in their garage. The following items were completely destroyed, not salvageable. And so we have a poster bed, pool table, flat screen TV. Now we have to list the fair market value just before the damage occurred. And this is complete destruction of the property. And then we're going to compare that to the original, really the basis, the original item cost. As a deduction, the first thing you need to do on an item by item basis is you need to take the lesser of the fair market value just prior to damage or the original cost. And in many cases, these kinds of personal items go down in value. But because this is an antique poster bed, there was an investment component potentially to this. And so it actually went up in value from $5,000 to $6,000. Well, when we claim the property as a deduction, we don't get to take advantage of that $1,000 increase in capital gains. We have to report the loss at the lower of the two, which is the original item cost. The pool table, flat screen TV, they both, like as is typical with most personal property, they went down in value. So we'll take those fair market values and pop them in here. Then we'll add these together, and this is the total amount of the allowable loss at this stage before we do any adjustments. All right, to continue on with the problem, it says the homeowner's insurance policy had a $10,000 deductible for personal property, which was deducted from their insurance reimbursement of $12,700, resulting in a net payment of $2,700. Their AGI for 2017 was $50,000. What is the amount of casualty loss that Ronaldo and Sonia can claim on their joint return for 2017? So in this case, we need to look at, for example, we need to include the net unreimbursed cost, right? So that's going to be $12,700, which we calculated above, and we're going to take out the money that came in from the insurance company of $2,700. So our unreimbursed net loss is $10,000 this year. Okay, so now we need to deduct $100 per event. So it's not per item, it's for the entire event for water heater damage. So that's one $100 reduction. And then as we look, we have AGI of 50, and that's consistent with what's listed in the problem, $50,000. So again, we're going to be subject to taking $100 away from the $10,000, $9,900, and then we're going to compare that to 10% of $50,000. So loss excluded due to the 10% is $5,000, right? 10% times $50,000. And then the total unreimbursed loss not deductible is $5,100, right? Because not only do we have to exclude 10% of the AGI, but we have to exclude this $100 as well per event. So of the total loss of the $10,000, we can only claim $4,900 as a deduction on Schedule A. So if you have any questions on any of these problems, as I said, feel free to email me or call, and I'm happy to go through any of these things with you. Thanks.